A few years ago, I decided I wanted to start investing, but I knew nothing about it and I had no idea where to begin. Like most people probably do, I tried researching it online, but there was just so much information and it was honestly overwhelming. And a lot of it was quite confusing, scary, or just too advanced for what I needed. The questions I had were so basic that it was hard to actually find them answered in a simple way that was pitched at my level. So if you're brand new to the concept of investing, I'm going to explain the basics in really simple terms. We'll cover stocks and bonds and also some less common types of investments. By the end, you'll know what the major types of investments are and how they work. But let's start with the very first question. What exactly is investing? At the most basic level, investing is using your money to buy an asset, or sometimes just part of one, that can potentially grow in value. It's similar to putting your money into a savings account, but instead of keeping it for a rainy day, you're putting it to work for you. You're using it to make more money. But don't savings accounts also make money? Well, yes, but there's a few differences. Money in a savings account earns interest, which is simply a small percentage that the bank pays you for holding that money in the account. But with most investments, you actually own an asset, and like with any type of asset, the value can go up or down. More on that later. First though, let's look at some of the main asset classes you might have heard about, starting with stocks. Stocks are a way to invest in companies. You can do that through buying their shares. When a company is publicly traded, that simply means its shares are available for anyone to buy on something called the stock market. You can think of the stock market like a virtual market where anybody can go to buy or sell company shares. Prices go up and down due to supply and demand, just like in any market. This means that if lots of people buy a stock, the price goes up, and if lots of people sell, well, the opposite happens. You might be wondering what the difference is between stocks and shares at this point. Well, the terms stock and share basically refer to the same thing, but they're used slightly differently. Stock refers generally to the stock of a particular company, so you would have Apple stock or Microsoft stock, whereas shares are the individual units of that stock that you can buy. Kind of like how if you had a cake, the cake would represent the entire stock, and the individual slices would be shares. Buying stocks is one of the most popular ways to invest. When you buy a stock, you become a shareholder in that company. If the company grows and makes more money, the value of your shares increases, and you can make a profit when you sell them. The next type of asset class is bonds. When you buy a bond, you're essentially lending money to a company or government. In return, they promise to pay you back your money, also sometimes called the principal, plus interest along the way. The interest, or coupon payments as they're known, are what you earn in exchange for lending them your money. Unlike stocks though, bonds are not publicly traded on an exchange. Instead, you either have to purchase them through a broker, or in the case of government bonds, you can buy them directly from the government. Bonds are especially popular with people in or near their retirement because the regular coupon payments give them a predictable stream of income. Like stocks, bonds can also rise and fall in value, but they're generally considered to be more stable and less volatile than stocks. Most of the time, they at least move differently than stocks. So there's some chance that if stocks go down, bonds might go up, or at least go down less. For this reason, they can also be useful even if you're not retiring anytime soon, because they can help to smooth out any ups and downs you might see in the stock market. Finally, there are a lot of other things you can invest in, which I'll group under the general term of alternative investments. This would be things like commodities, property, crypto, art, wine, startups. They would all fall into this category. These kinds of investments tend to be the riskiest and the least accessible to beginners for a few reasons. One reason is that they often involve a higher degree of illiquidity, which means it can be difficult to quickly buy or sell this type of investment. You can typically sell shares a lot faster than you can sell a house, for example. They're also sometimes not regulated as strictly as traditional stocks and bonds, making it much harder to even predict how risky these investments might be. And they're often much more volatile as well. So, while alternative investments might have the potential for higher returns, they also come with a much higher level of risk and uncertainty. This is not to say you should never own an alternative investment, but it's usually not the easiest or safest way to get into investing for a beginner. So that's investing in a nutshell. But one thing I haven't covered is, why even bother? Wouldn't it be easier to just put money in a savings account and avoid all of this risk and complexity? Well, the main reason people invest is that over time, investing can usually make you more money, sometimes a lot more. Let's look at how in this next video.